स्टार्ट करिए.
We can start? Sure. Good evening and welcome everyone, and thank you so much for joining this amazing course for accounting standards. I'm CA Rudesh Khania, the regional council member. I request our backend team. So are we playing the motto today?
नहीं sir.
Krishna ji? Okay, we played on the first day, right? All right, sure. So I'm sure you had an amazing time in this entire series of the refresher course. So thank you so much, everyone. First of all, thank you so much, Subhash sir, for being a faculty for accounting standards for all our participants. To talk about Subhash sir, Subhash Bhide sir is a CA fellow member of our institute, holding a diploma in IFRS from ACCA. He has been imparting trainings to aspiring chartered accountants for more than 3 decades. He specializes in delivering training in financial reporting, financial management, and income tax, including international tax. He's conducted training courses for corporates and CA firms on accounting standards, IFRS, Ind AS, income taxes. Currently associated with Mukund M. Chitle and Company in an advisory role relating to accounting, financial reporting, and taxation. And I'm sure it's going to be a great learning today on practical aspects of accounting standards. Thank you so much once again from me, Regional Council Member Rudesh Khania, and our entire team of WRC. Thank you so much. Over to you, Subhash sir.
Well, thank you for a very generous kind of introduction. Hello, everybody, all participants. Welcome you to this last part of the group-related standards. I hope everybody is able to see me and I'm audible clearly. Now about
sir, आपका PPT शेयर करिए.
PPT I have shared. Is it visible now? Hello?
नहीं sir, अभी तक नहीं आया PPT.
Just a moment.
अभी करिए. अभी आ गया sir.
Now is it visible?
Yes sir.
Okay, shall I start now?
Yes sir.
Okay. Hello everybody. Let's begin with group related standards, page 21, 23, 27 and also page 14. At the outset, let me tell you a few things. Though we are going to study the standards, accounting standards, the old ones, IGAAPs, what you call Indian GAAPs, we need to have also some understanding of the connection with Companies Act, the provisions under the Companies Act, of course, 2013. Now, why? Because under the Companies Act, there are certain things which are defined and they are at variance to a certain extent with what the standard says. For example, some definitions. There are some subtle differences. Companies Act also gives you the details or provides the details about what is to be reported. Whereas accounting standard basically deals with reporting only. So it is expected that it should match 100%, but then to a certain extent, little changes here and there are there. With this background, we're going to see that Companies Act provisions also. One more thing, by what way I'm going to present these slides, etc. for you. We are going to see, first of all, in the accounting standards, the definitions under the Companies Act and under the accounting standard. Thereafter, the basic principles, the application of the standard. And lastly, we are going to see some critical issues. There are some issues where, perfect guidance is not available, some debatable matters where there could be differences of opinion. We're going to see some items on each standard. And after each standard is completed from my side, I will give you time to ask me any of your doubts, queries, some insights from you also. You can post your queries and the organizers will, at the end, will show me on the screen what the queries are, and I'll go on answering them to the extent time permits. Now 4 standards are there and we have got 3 hours. Okay, so time is always a constraint, and I guess members are knowing, the participants are knowing what the standards are to a certain extent, though I will not assume and leave everything to you. But then rather than looking at the computational part of the standards, which you have been doing since your exam time when you were students, our emphasis is on learning the nuances, something beyond just the calculation. Having said that, here we go. The first standard that we have picked up is Consolidated Financial Statements, AS21. Now forget for the time being IFRS. There is no IFRS in India, just forget that. Because if that is mixed up, then there could be trouble. We are just going to look at the erstwhile standards, which are now being upgraded, and we are moving towards IFRS era. For the time being, forget all that. The introduction. Significance of preparing consolidated financial statements. When the companies prepare their separate financial statements, then why is it that consolidation is required? Consolidated financial statements of parent, holding company, and all its subsidiaries together. Why is it required? Basically, it is all because of the information needs. There are companies in India which have multiple subsidiaries. More than 100 subsidiaries are there. Now, if you keep looking at different subsidiaries in their balance sheet for 6 months, still picture will never be clear because it will be in scattered form. So basically, objective is what? The users of the financial statements basically are concerned not only with individual statements, but if a parent has made investment in subsidiaries, how safe the investment is, rather than safe, how profitable the investment is, how successful the investment is. They want to know, and from that angle, this need of getting the information is fulfilled. How fulfilled? By separate financial statements showing the strength of the entity, and also by preparing the consolidated financial statements to give full health picture of the group, the assets that it controls, the liabilities that it obliges, and what is the financial strength of the whole group in one nutshell format. And that's why consolidated statements are prepared. Now let's go over quickly to the definitions. Whatever your queries are, you can park those for the time being so that flow will not be affected, and at the end of the standard we'll take up those queries. You please keep noting down and send it to the organizers, and at the end we'll discuss. Now let's begin with the main definition, holding company. Mind you, Companies Act, I'm talking about 2013 Act, it uses the word company, holding company, subsidiary company, whereas standard doesn't use the word company. We will go into the depth little bit. Holding company, section 2 clause 46, forget section numbers, they are given only for the sake of academics. Holding company in relation to one or more other companies means a company of which such companies are subsidiary companies. Emphasis on companies, right? Now, in contrast, the accounting standard uses the word parent. Parent, it never says company. So it could be anybody other than company, but basically, mostly companies are the ones who prepare consolidated statements. So primarily our focus is on that, but just remember that's not necessarily the only entity covered. So parent is an enterprise that has one or more subsidiaries. Nowhere the word company is there. Companies Act speaks about companies. Accounting standard speaks about everybody, consolidation of everybody, those who fit into the definition. So obviously, what is a subsidiary? Again, Companies Act, subsidiary company. Now watch carefully. Watch carefully. I've done the animation so that you know at a time one line, 2 lines will come on the screen. You can peacefully watch it simultaneously. Listen to me. Subsidiary company in relation to another company, which is holding company, means a company in which subsidiary is a company in which holding company, watch carefully, controls the composition of board of directors. Controls the composition. Control is the key factor. It has always been, even in the IFRS. We are not going to see that today, but control is the key factor. We are going to see what it is. Or either controls the composition of board, or means both need not be fulfilled simultaneously. They are alternative conditions, not cumulative. Exercises or controls. See the controls in the first condition, in the second one. More than one half of the share capital of either individually or together with the subsidiaries. It's necessary that company itself directly should control, which may control through its own subsidiaries. Now, what you observe here is that number one, either controls composition or exercises control over the share capital. Both well and good. But if you control only share capital, you would say, how is it that the board of directors are not controlled? Generally, the company which has substantial shareholding, it also incidentally has a right to appoint the members of the board. Suppose shareholders agreement is there, or some kind of arrangement is there whereby somebody else, A Limited, controls the share capital more than 50%. B Limited controls the board of directors of one company called XYZ. Then what? It will be subsidiary of both, isn't it? So we are going to see this issue little later in the critical issues. But just remember here, one of the two conditions is enough. Provided that, now this is something special from Companies Act 2013. Provided that such class or classes of holding companies which are prescribed, those which are prescribed shall not have layers of subsidiaries beyond such numbers as may be prescribed. Up ahead we are going to see a company may control another, another may control still another may control one more. How many layers are permitted? We're going to see that up ahead. But for the time being, understand control of board of directors or control over the share capital directly or indirectly, but not more than limited number of layers. Why? Logic, how many? We'll see that later. For the time being, just understand direct control, indirect control. Now, this is as per Companies Act. What does the standard say? AS 21 colon means para number 5.2. What does the standard say? Well, subsidiary is an enterprise that is controlled by another company. That means control is again there, but the definition seems to be shorter. But that is a technical difference, because if it says it's controlled, up ahead, what is controlling that? All these things are included. So basically, it's not going to be much different, but control. Okay. Now we'll watch in this total share capital. Why? Because we have just now seen here, my cursor is moving here, total share capital. It's not equity, total share capital. And by the way, this total share capital, where is it defined? Not in Companies Act. There is some set of rules, companies specification of definition details, rules of 2014, subordinate legislation. In that, only clause R we are concerned with. The whole of the entire rules we are not concerned. So what does it say? Because total share capital is relevant for deciding control. Total share capital for this purpose, for all these sections, whatever are relevant, it means aggregate of the following. Paid up equity share capital. That's okay, very simple, no issues here. But paid up equity share capital and convertible preference capital. That means convertible preference shares of the subsidiary or some other company which is being controlled are also counted. Now that leaves a lot of questions unanswered. Convertible means what? Compulsorily or even optionally convertible? No guidance from the Act. Convertible preference share capital. Now, convertible preference share capital before conversion also you will take into account, or only when it is converted you will take into account? There is no guidance. So, if a company has got equity and convertible capital. One company controls 100% equity, 60% equity, sorry. Other company controls 40% equity, but 70% preference. What will happen? Lot of debatable matter is there. But mind you, basically, equity share capital contains voting rights mostly. So primarily speaking, equity share capital will be the most relevant factor. Preference share capital, unless we come out with some kind of guidance or rules from the government, at the present moment, convertible preference, how to what extent to take into account, it's a big debatable issue. But keep in mind, the preference share capital has got something to say in this matter. Now, companies, restriction on number of layers rules. This is a typical feature of Companies Act. More than the Act, in other rules and subsidiary kind of legislations, they keep providing. Now, this is very interesting. Watch this. Not more than 2 layers are allowed. Just 2 minutes ago, I told you that only so many layers as they will specify, not more than 2. Don't forget how to calculate 2 layers. How to calculate 2 layers? More than 2 are not allowed. How do you calculate 2 layers? Foreign subsidiaries beyond 2 layers, as per the laws of that country, are permitted. So in the layers, if there is a foreign subsidiary and then other 2, it will not be 3 layers. It will be called 2, because foreign subsidiary will not be considered as per that country if it is permitted. I've taken one example. Just have some patience. We will first learn this and take an example on this. One layer which consists of one or more wholly owned subsidiaries not taken into account. So in the layers, what is taken? 2 layers taken into account. What is not taken into account? Foreign company or 100% subsidiary company. We'll have to take an example to understand this, but just observe this first. I'll give you an example. And last point, restriction is not applicable. Whenever there is a rule, there are exceptions. These restrictions do not apply. Let me tell you why these restrictions are brought. Restrictions are brought because siphoning of the resources or doing something not expected by the government to be done, financial irregularities are possible. I'm saying every layer doesn't mean that there is a irregularity, but possibility is there. Government wants to stop that. So obviously these restrictions will not apply to what? Obviously those companies which are concerned with finance and related issues. To those, if you put this kind of conditions, that wouldn't be fair practice, right? Look at who are excluded. Banking company, systematically important NBFC, finance related, insurance company, and government company will never do anything wrong. Okay, so these 4 number of layers don't apply. All others layers will apply. How many? 2. What is not counted in 2? Foreign subsidiary or 100% subsidiary. Now just go to the next slide for an example. Watch this. If you have not read, just go through. In a minute, we'll go to the next one. Okay, example. Watch this. Ultimate holding company is A Limited. We are talking about 2 layers. Subsidiary of A Limited is B Limited 100% and Z Limited 60% shares held. So which will not be counted? Participant must have guessed. B Limited will not be counted. Z Limited will be counted. Now subsidiary, step down subsidiary of B Limited is C Limited. Whatever percentage. Subsidiary of B Limited, subsidiary of C Limited is D. So 2 layers. Below A, you can see 3 companies B, C, D, but layers are only 2 because we don't count B. So can we say, while counting 2 layers of subsidiaries for A Limited, beyond which you are not allowed, wholly owned subsidiary B will not be counted. So A Limited has not breached the rule for restriction on number. But mind you, D Limited will not now have a subsidiary, because if D Limited has a subsidiary, okay, then A Limited has breached. A Limited is restricted from having layers of subsidiaries. Okay, so this is a very simple example. Now below Z Limited, nobody is there. If Z Limited, below that subsidiaries are there, you will go by the same logic. So this is about restriction on number of layers. Now there is a certain repetition. You will find that, sir, you are repeating somewhere some things because they are given at multiple places. Section 186, which deals with some kind of investments and loans by companies, something different. That section also speaks about it. So I'm just repeating it. Company can make investment through not more than 2 layers of investment. Just now we saw. And what are the exceptions? Investment made in a foreign company, having investment subsidiary for the purpose of meeting some objectives under some legislation. If government has permitted, government convenience ke liye, this is there, right? So this is section 186, more or less on the similar lines. So now we have seen holding and subsidiary company. Now we need to see what is meant by control. We need to see what is meant by control, because control is the key factor over here. It means, first of all, under the Companies Act, we'll see what is control. Now watch, I have underlined for your easy reference important points. Shall include right to appoint. Mind you, they have not said right to remove, but basically right to appoint and right to remove are simultaneous. Plus, up ahead, there is something else I'll show you where they have said control over the board of directors. Not just appoint, control over the board of directors means appointing, removal, everything comes, right? Right to appoint the directors or control the management or policy decisions. Either right to appoint managing persons or take policy decisions, management or policy decisions exercisable by a person directly, indirectly, whatever. By virtue of shareholding, watch, control by virtue of shareholding, underlined part, control by way of shareholding or management rights or shareholders agreement or voting agreements or any other manner. How wide this is? Basically, control, people believe, is through equity shareholding, but it can be a very wide method of control. And what Companies Act is now saying is going beyond accounting standard 21, because it is something going close to IFRS or Ind AS. There the control concept is very wide, which is not a point of discussion today, but I'm just letting you know it is going beyond just AS 21 requirements. So any kind of control is included. And what does our standard say? Standard speaks about consolidation. So it also has to state what is control. Ownership of more than 1/2 of the voting power. Watch. Control over the composition of board of directors. Composition means appointment also, removal also. So as to obtain economic benefits. Now, so as to obtain economic benefits, please store it with you in mind. At the end of this standard, we are going to see some critical issues. One of the critical issues is where so as to obtain economic benefits. We are going to see that. Okay. So basically, control means through shareholding, party controlling the decision-making process and composition of board of directors. Though in most of the cases, commonly we find control is through shareholding. Now, when you say definitions are differing, then somebody would say, which definition we should apply? Definition as per company law or definition as per standard. Basically, section 2, like in any other acts, it starts with which wording? Unless the context otherwise requires. All definitions are preceded by the wording unless the context otherwise requires. In short, it means that normally company law definition will prevail. If context requires that this should be kept aside, then you will have to use other definitions. So significance of this wording is what? If primarily, fundamentally, Company Act definition will apply. In case, in some context, it can be interpreted that some other meaning is expected. Obviously, you have to go beyond that. Okay, we are not learning law as such. So I'll leave it at this only because we have got many more important things. So what have we completed? We have completed the definition part of it. What we have seen? Holding, subsidiary. What we have seen? Control. Control is through what? Shareholding or through control over board of directors decision-making power, right? And not more than 2 layers permitted for subsidiary holding relationship. exceptions are there. This is what we have studied. Now let's see application. Now this will be from two angles, from company law angle and from accounting standard angle. There would be some subtle differences. So let's see from AS21 perspective. The consolidated financial statements means what? You will say, sir, this is very simple. Consolidated financial statement means statements of a group. Okay, let's find some other meaning. Consolidated financial statements are the financial statements of a group presented as if it is a single enterprise. You know what is special? Financial statements of a group. So if there is no group, there will be no consolidation. Okay. So what is a group? Group means the same standard says ahead, parent and all subsidiaries. Parent and all subsidiaries. There are two important points. Point number one, all subsidiaries. You can't leave out any subsidiary at your sweet will. Can there be exceptions? Yes, there are. We're going to see those. So exceptions are there. And secondly, all subsidiaries, not associates, not joint ventures. They are not in the group. That means if a company doesn't have a subsidiary, so it will not have a group, but it has associates, it has joint ventures, then what it will do? Think about it. We are going to come to that. At present, what we have seen, financial statement of a group is consolidated statement. Consolidation के लिए, it is necessary to have a group, and group means only subsidiaries. This is what you keep in mind. Now, Company Act perspective. There are 4 slides. This is the first out of 4 slides. From Company Act's perspective, section 129, which speaks about completely financial statement, we are going to see only subsection 3 and 4 regarding consolidation. Right? Consolidated financial statements, I have simplified it in 3 points. 3 points you have to remember. Very simple. Number 1 should be of all subsidiaries. That's what accounting standard says, of all subsidiaries. In the same form and same manner as if of its own. So if I have a particular format, I should prepare in the same format, even if subsidiaries format is different. There is something that we are going to learn up ahead on this point. Just for the time being, just learn it. Application we are going to see ahead. Form should be same, all subsidiaries to be included, and shall also be led before the annual general meeting. This is the auditing aspect. I'm not going to deal with this. That means they are also required to be approved by the board, blah blah. What do you do of single standalone statements? Same thing you do of the consolidated statement. It will have its auditing issues. I'm not going to deal. For example, subsidiary statements are getting late. They are not giving it to us. So can holding company wait or go ahead with its statement? These are the auditing aspects. Also attach along with financial statements, consolidated statement. What do you attach? Separate statement containing salient features of the standalone financial statements of subsidiaries. In other words, preparing consolidation and attaching extra statement are the 2 requirements. In spite of consolidated statements, but still attach something. And the last point over here, AOC 1. There is another form under companies rule number 5, AOC 1. There is nothing great in that, so I'm not trying to show it because I've got so many things to cover, But AOC form is available. You can see that there is nothing, no great information available. And the central government can provide manner of consolidation. How to consolidate? Government always gives the power to decide. So basically it is very simple. It speaks about consolidated statement, all subsidiaries, same form, and follow the same procedure as you follow for normal statements. Now we come to the next and important part. I've told you that main act plus the subordinate paraphernalia, right? Rule 6 of companies accounting standard rules, and in fact it is amended also. 2 things we are going to see. See, we are going beyond the act also. In accordance with the provisions of Schedule 3, you are supposed to prepare. Schedule 3 basically has Division 1, Division 2, Division 3 for different types of companies, AS companies, Ind-AS companies, NBFCs. And for consolidated statement, they have given something special. We'll just have a look at it a little later. For company exempted from preparing CFS under the accounting standard, there are two things to be given. It is sufficient if you comply with the statements. It is sufficient if you comply with the Schedule 3 requirement. Now, who is the company which is exempted? Because if company is exempted, go to Schedule 3. Whatever details they have asked, give those details and don't prepare. Which is the company which is exempted? Watch this. Which is the company which is exempted from preparing? Again, rules exemption from preparing CFS. Rule 6 of companies rules. Beyond Companies Act, this is going. Now, intermediate, I will give you in simple form an example. How 10 minutes ago I gave you an example like that. Intermediate subsidiary is not required. We'll see what is intermediate subsidiary. But exemption is not available to foreign subsidiary, even if it is intermediate. This is what that rule says. Who should not prepare, not required to prepare? This one. Let's take an example. A Limited is ultimate parent. B Limited is 100% subsidiary, intermediate. So you know, first line, intermediate subsidiary is not required. So if B Limited has a subsidiary called C Limited, 100% subsidiary of B, then B Limited need not prepare consolidated statement. We are intermediary. Our ultimate parent A will prepare. B can just walk out and say we will not. But B Limited need not prepare consolidated statements. A Limited will have to prepare. But what is the exception to the exception? If A Limited is incorporated outside India, ultimate parent outside India, B Limited is not exempted. You will have to prepare. That means B Limited, C Limited group, they will have to prepare. But if A Limited is an Indian company, then this exemption is available. Now, what happens if this exemption is available? If B Limited is having exemption, don't prepare consolidated statement. But then what do? You will have to give the details. Given where? Schedule 3 to the Companies Act. They have given. We are going to see what those details are. Consolidated statement, the last of the slides from Companies Act perspective. Section 129 subsection 3 says, now watch this. Subsidiary shall include associate company and joint venture. When we saw the definition in section 2, it was written unless the context otherwise requires. In the same act, context otherwise requires. Subsidiary shall include associate. Basically, associate is strictly not a subsidiary. You're going to see in the second standard what it is. But subsidiary shall include. Now, if a company has an associate and joint venture, can you say that you have to prepare consolidated statement because subsidiary is included? And if it is a subsidiary, there is a group. Well, people are opining in different ways. If you ask me, no liability accepted, just an opinion that basically group means primarily defined as holding and subsidiary. Associate is considered as subsidiary only when you are preparing the group statement which is otherwise existing. Holding plus subsidiary otherwise existing. Then associate also you include. But if there is only associate, I don't think that you need to prepare consolidated statements. And the second thing, 129 subsection 4, provisions of this act, this is auditing aspect, I'm not going to cover. Preparation, adoption, audit applied to consolidated the way they apply to standard. That is not our point of study, but just for completion, because I'm going to share these PPTs with you. So everything will be at one place. So basically what we have studied so far, what is control? Associate, joint venture are considered as subsidiary. Now guidance under Schedule 3. I kept telling you Schedule 3 keeps telling you about guidance. Why guidance is required? Because everybody knows what are standalone statements. In consolidated statements, there is something else required. So this guidance is provided by the Schedule 3 to the Companies Act. We are going to have an overview. We are not going to mingle around just 10-15 minutes here, not at all. They've given general instructions when you are preparing consolidated statement. Let's have an overview of that. Now, requirements of this schedule are applicable in preparation of balance sheet and profit and loss. This is your introductory line. It says CFS shall disclose the information. Consolidated financial statements should disclose the information as per the requirements specified in the standard. Now, this schedule asks you or authorizes you to go to AS and use that AS 21 and do it as per there. But this schedule says even though you have to prepare the statements CFS as per schedule, as per accounting standard, we want some more information to the extent not given in accounting standard. What is that? Profit and loss attributable to minority interest and owners to the parent shall be presented. I mean, it will have to be disclosed when you prepare P&L. Generally, P&L means what? Income, expenses, taxes, profit after tax, EPS. Profit after tax, to the extent it belongs to minority holders, show it. To the extent it belongs to the parent, show it. They have specified that we are required to show that. And similarly, minority interest in the balance sheet within equity shall be presented separately. I hope you heard about FRRB, Financial Reporting Review Board of CA Institute. It keeps observing the financial statements prepared by various entities, and they keep commenting wherever deficiencies are observed for improving quality, right? I have found many such issues. One of them I distinctly remember where it was mentioned that minority interest was shown as a part of liabilities. Some of them showed minority interest in the equity. It should be in equity but separately. Under the head equity but separate sub item. It is required to be shown. Okay. Disclose the list of subsidiaries or associates of joint venture. Now watch, 2 minutes ago I told you Companies Act says subsidiaries includes associates. Then why you are saying subsidiaries or associates or joint venture if they are subsidiaries? That clearly shows the intention of the law is very limited. Subsidiary includes associates, joint venture, very limited. They have said separately. Strictly speaking, it is not a subsidiary. Okay, and you have to give the details. This is what Schedule 3 says. So, if a company is required to prepare consolidated statements, still it has to give. If it is exempted from consolidation, still it has to give this information. It is a must. Now, in this guidance, what you are supposed to state? Schedule 3, I told you just now the general requirement. Now a table I will show you. Look, this is the table, which is self-explanatory. I need not tell you, it's very simple English. What you are supposed to show: details of the parent, subsidiary. Subsidiary aa gaya to minority interests also, how much belongs to outsiders, associates, joint ventures, how much are in India, how much are outside India. What is the share of net assets, percentage and amount? What is the share in profit, percentage and amount? You know why this is? People should not be made to look into the profit and loss, into the balance sheet and search where is the share of assets from the subsidiary. It should be readily given, which is there in P&L, but here it is easily accessible. That's all. So it's a very simple statement. Now, we start with the main part, the computational part, which we'll do to a certain extent, because I believe consolidation, preparing that the participants must have done. So you are not going to solve the problems here and show how to do that. It will take a lot of time. But we are going to see the guidance. Consolidated financial statements, see the underlined part. Same format as adopted by the parent. Same format. Suppose Schedule 3, Division 1 applies to holding company. Division 1, AS company. Schedule 3, Division 2 applies to subsidiary, Ind AS. The formats are different. Holding company is an Indian company. Subsidiary company is a foreign company. Format is different. They are saying same format as that adopted by parent. So what you should do? Holding company's statements will not be changed. It's holding company. Subsidiaries statements will be changed. The format will be changed from whatever it is to the format for a standalone statement which holding company uses. And after you change it, then you consolidate. So first step, subsidiaries statements, check. Are they in the same format as that of standalone or holding company? Yes, go to consolidate. No, second step. convert the subsidiary's financial statements in the form in which holding company prepares it, and then second step, combine. All the notes need not be included. Holding company gives 35 notes, subsidiary is giving 45 notes. So will you add both? Out of them 25, 30 may be common. Will you add all? No. Obviously, we are going to see up ahead this particular point. Those which are material, those which are essential in understanding true and fair view include. And those which are sundry, for example, subsidiary is declaring something under the schedules applicable, law applicable to it. When you consolidate, what's the use of that? Because that's for legal requirement, something was given. That doesn't affect true and fair view. So such irrelevant notes need not be, but mind you, you can't pass off some important ones under this concept. Okay. Notes involving items which are material to be included, and additional statutory information which you have, there is no need. So this is basically simple. What is to be included, what is not. Still, computational part is not conducted. Now, general principles of consolidation. General principles of consolidation. First, I'll give you general and then procedures. This accounting standard says line by line item, like PP, holding subsidiary, add PP. Current assets, inventory, inventory of holding and subsidiary. Go on adding all line by line all the items to be added, which is very simple. Then secondly, the drawn up to the same reporting date. Usually in India, you find everybody follows 31st March as the accounting year. By chance, subsidiary statement is not 31st March, 31st December. Okay, you take that balance sheet of 31st December, but you can't consolidate directly, right? Two dissimilar things, pens and pencils cannot be added. There, that has to be similar, right? Therefore, between 31st December and 31st March, whatever adjustments have taken place, if that is not practicable, make adjustments for that and prepare statements which are compatible and then consolidate. This is what you have to do. In any case, difference between holding companies year ending and subsidiaries year ending cannot be more than 6 months. Otherwise, you can't say, I'll make adjustments. So what, 9 months old balance sheet I'll take for consolidation. It cannot be more than 6 months in any case. This is a simple kind of general guideline or principle. And the second part of the guidelines, this AS 21, para 2021 are also saying something. Use uniform accounting policies. Now, this is a bone of contention. Many times it happens that subsidiaries, they have got a different set of accounting policies. So it becomes difficult to consolidate. Nothing doing. If first of all, policies should be same. If they are not, and if it is not practicable, then make adjustment. And if it is adjustment also not possible, then at least mention which are the parts for which subsidiary is following different accounting treatment while consolidating, and we have not changed that. You have to mention that. But again, FRRB has reported many times that this has been misutilized, mishandled. Okay, so it is necessary that you have to mention the percentage. Appropriate adjustments are to be made, and you have to mention the percentage of items. No guidance on how to decide percentage of items for which you have not applied this similarities, but then some way has to be found out. Okay, general principles. Now we go to the consolidation procedure. Participants, friends, let me tell you, if I have to teach you the procedure of how to calculate, today I will not be able to do any other standard. Basically, we are not doing that, but then still, for the sake of complete understanding, a little example I'll give, which will be very simple, and it will help us to go ahead. Our objective is to look at the other factors. Let's say holding company means a father having his business, father's balance sheet, that is holding company's balance sheet. He is having 100% shareholding in son's balance financial statements. So son's balance sheet is subsidiary's balance sheet. Now what will you do? For this consolidation of father and son family balance sheet, consolidated balance sheet, pre and post acquisition profits of subsidiary, that is the first important point. And for that, the date of acquisition of control is the most important part. The day on which you acquire control. Obviously, the day on which you become parent, you become holding company. That's the day, the starting point. Every balance sheet, every consolidated balance sheet starting point is the same. The day on which you acquired the control. Now, reserves and profits, the day on which control was acquired, they are considered as pre-acquisition. Suppose on 1st April 21, control is acquired. On 1st April 21, whatever reserves are there, capital profit, pre-acquisition profit, and after that day, whatever is acquired, post-acquisition. This is a very basic thing. Now we come to the consolidation procedure, the next part. There are 10 slides on this particular matter. Just observe very simple example. Father's balance sheet and son's balance sheet, we are going to consolidate. First, line by line, you will add all items. Father is having 100% control. So all PPE, cash, inventory, receivables, payable, everything you will add. So if I add father and son's balance sheet, all the items, what will be left? Only the share capital. Suppose there are no reserves. No reserves. So share capital of the son's balance sheet, share capital will represent assets minus liabilities. Now when I combine, all assets and liabilities are added. But will I say son's share capital and father's investment? Show both. No, when you combine son's share capital and father's investment will get knocked off. This is what you have to eliminate. What do you eliminate? Cost to the parent. Cost has got some explanation. Cost to the parent of investment in subsidiary. Cost of investment you will set off against what? I said share capital, but that was a simple example. First of all, in place of cost, if the carrying amount is different, then use carrying amount. Why carrying amount of investment will be different? Revaluation or impairment loss, investment might have been down. So either cost or whatever value appearing in the balance sheet. So cost should be knocked off against what? Parents' share of equity. Parents' share of equity. So obviously parents' share of equity will be what? Parents' share of equity. Aggregate of share capital held and the reserves. Aggregate of share capital and the reserves. So in the son's balance sheet, share capital and reserve is nothing but net assets. So if I add all the net assets of the son in father's balance sheet, it is as good as share capital and reserve added. So what will I do with share capital and reserve? That share capital and reserve and investment will be knocked off. If investments are costing 1 lakh, share capital and reserve is exact 1 lakh. No, balance sheet should tally obviously. But if I have paid 1,10,000 and share capital and reserve is 1 lakh, I have paid 10,000 more, so that will be goodwill. If I have paid 90,000 and share capital reserve is 1 lakh, I have paid less, that will be capital reserve. You must have studied that right since your student's age, right? So if A is more than B, that will be goodwill. 1 minute ago I told you. And if A is less than B, capital reserve. This procedure is fundamentally known to everybody. Now, analysis of profits and goodwill and capital reserve, how do we do? Just now I showed you. The day on which control is acquired, pre-acquisition profit, all profits thereafter are post-acquisition. So when we acquired control, what is the reserve? What is the P&L balance? That is a capital profit. What happens thereafter is post-acquisition profit. Now I gave you the example of father acquiring 100%. If father has acquired 90%, then 10% belongs to somebody else. Somebody happens to be minorities, right? Therefore, remove the minority part. What remains belongs to the holding company. The question is where to show. Where to show. This first column that is included in goodwill and second column is included in P&L. When I acquire some shares in subsidiary, whatever is my share, that capital part goes in calculation of goodwill and revenue part goes in my P&L. Whatever profits I get will be added to my consolidated P&L. And that's the reason this is how it comes. Whatever is the amount invested, that is compared with parent's portion of equity, which I told you how to calculate. If it is positive, it's goodwill. If it's negative, it's capital reserve. Most of you have been doing this right since CA final stage when you were students. So this is for completion stage I'm covering. And minority interest will be what? Whatever belongs to minority. Share capital, how much minority holds. Share of profits, how much minority holds. That belongs to minority. This is the one. This is what the standard says, and this is what I have prepared. Whatever the standard says, amount of equity attributable to minority and minority's share in the post-acquisition profit. What belongs to minority? Share capital. How much do they hold? And profits at the time of acquiring control by us and after. All that belongs to minority. So finally, what do we show in our balance sheet, consolidated balance sheet? All the assets and liabilities. Please remember, all the assets and liabilities of the subsidiary. Suppose I hold 70%. So all the assets and liabilities I'll add, and I'll say 30% doesn't belong to me, minority interest. So 70% belongs to me. Add all assets and liabilities, say 30% doesn't belong to me, 70% belongs to me. That will be in goodwill or capital reserve. That's how it is shown. Now, minority interest in the net income. This is not a very important part. This particular slide for completion part I have said. Minority interest in profit and loss, you have to show total profit, holding plus subsidiary, less what belongs to minority. You have to show. Similarly, total assets, what belongs to minority. You have to show. Similarly, minority interest, where do you show? Separately presented. So basically, from consolidated balance sheet, if someone wants to know what is the share from the subsidiary belonging to minority, look into the P&L. You will come to know the complete profit of the group. You will come to know what belongs to minority and what belongs to parent. If you look at the balance sheet, you will know all the assets of the group. Look at the minority interest. You will come to know out of the net asset how much belongs to minority, and that should be separately presented. This is what presentation aspect is. Now, suppose now we are going to see, not we have gone beyond the calculation. So what the students also know how to prepare. Now we are going to see some exotic other areas. Suppose minority interest is negative. Negative, that means recoverable. So will you show it on the asset side? Minority interest, asset side. Well, primarily you should not show that way. What does the standard say? Standard says such figure and further losses applicable to the minority. If because of the losses minority interest is negative, are you going to go to the minority shareholders and say, come on, negative, contribute to the group, pay us the money? Their liability is limited by the shares that they hold. So you are not going to recover anything. Then what are you going to do? It is adjusted against majority interest. What do you mean by adjusted? Standards is adjusted against majority interest. When you have share capital, reserves, equity of the parent, minority interest less, and a debit balance of minority interest rather than on asset side, it should be deducted from the liability side from the equity attributable to the parent. And do not stop loading it unless, of course, they have said they are able to make good the losses. I can't understand how on asset side you will show minority, they are able to make good. I don't think minority interest, minority holders will contribute. So mostly it will be shown as a deduction from the equity. And if subsidiary later on represents profit, reports profit, then they should be first of all wiped out earlier negative balance, then only it will be recorded. This is about presenting the minority interest. Now, elimination of extra items. All of you know that even if there are two departments in an organization, A and B, and if A department gives goods to B at a profit, in the whole company's balance sheet, interdepartmental profit is eliminated. Same thing applies here. Holding to subsidiary or vice versa, if goods are transferred, if there is a profit, father has sold goods to son, the father claim profit, but then in the whole balance sheet, it's like taking money from one pocket and putting into the other. So it should be eliminated in the consolidated statements. Very normal. And unrealized losses resulting from such transaction, the way profits are eliminated, should also be eliminated when you are preparing consolidated statement. But we are not, academically like students, we are not preparing balance sheet here, numerical. So we are not able to show the figure work out here. That is not the intention behind this lecture. Now we see consolidated tax expense and consolidated reserves. Suppose I have got 3 subsidiaries. 2 subsidiaries have deferred tax assets and 1 subsidiary has deferred tax liability. Can I net it off? Do you find combined consolidated return of all the three companies? Each company has a separate PAN. It is a separate SSE. It files returns separately. How can you do that? Therefore, do not net them off. Now, one thing is there. If 4 subsidiaries have deferred tax asset and 3 subsidiaries have deferred tax liabilities, I can add all the deferred tax liabilities in one figure. I can add all the deferred tax asset in one figure. That's okay. Don't set it off. That is what is written here. Current and deferred tax delay. Simply make aggregation, but don't set off. Don't set off. Then the parent share in the post-acquisition reserves. Post-acquisition reserves forming part of the corresponding reserve. What should be done? This is what. It is not required to be disclosed separately. I'll give you an example. Suppose I have got subsidiary and holding company. I have got share in the reserve, general reserve, share in securities premium, share in this reserve, share in that reserve. So will I show separately share in so and so reserve? No. In the respective reserve, my share I'll add consolidated general reserve. That will include. I need not show separately. I can just add it to my, this is just a presentation. I can add it to the respective share. And the last part is disclosure. I don't think disclosure needs to be explained, self-explanatory, but for complete knowledge, I have given it here. Just go on looking at it. Reasons for not consolidating subsidiary. I'm going to cover it when not to include. Why not? Because there's some exemption is given, but don't remain quiet. Be vocal. You have to state that this is the reason why we have not included subsidiary. It is not practicable to use uniform policies, then mention the same. List of all subsidiaries, country of origin, information, detailed information, documentary information. Nature of relationship between parent and subsidiary. If it does not directly own, maybe indirectly own subsidiary, how it is your subsidiary? Explain how it is your subsidiary. Effect of acquisition and disposal of subsidiaries during the year, and names of subsidiaries for which reporting dates are different. So basically, this is something which, by just having a look at it, one can understand. There's nothing thinking required over this disclosures. Now, the most important part, after which this standard will be over. First standard will take more time, second, third will take less time, and last will take some time. So I'll explain to you critical issues, and thereafter I'll pick up whatever doubts you have got. I'll answer to the best of my ability, whatever I can. Some critical issues. Now, first issue. Is it mandatory to include each and every subsidiary in consolidation? Each and every? No. There are exemptions that we already saw. That is directly as per the rules. More than one layer. B is allowed not to consolidate. However, if its ultimate parent is foreign, then not allowed. That's okay. But as per standard, there is para 11, which says in 2 circumstances, it is not necessary to include the subsidiary. But you have to be careful. Don't misuse this. You can't misuse it. I'm going to explain to you in details this particular issue. First of all, you will see that section 129 from corporate law angle, all subsidiaries to be included. Accounting standards angle, all subsidiaries. But there are exceptions. So though these are saying all, there are exceptions. Accounting standard 21 para 9 says that a parent which presents consolidated statements can exclude, as mentioned in para 11, in 2 circumstances. Now, where are they? We have continued it. When you can exclude, watch this. Para 11 says subsidiary can be excluded in 2 situations. The first is control is temporary. What is temporary? Next slide. We have to understand. And we are going to dispose it off in the near future. What is near future? Very dicey term. It is not mathematical term, right? So you're going to see that. Basically, if you hold temporary control, don't include. Why not? Because if you include subsidiary, it will create a picture of your strong balance sheet by including all the assets. But if you are going to dispose it off, very soon it's no more going to be the subsidiary part of your group. Then why include that? It is on the way out. But when? You're going to see that. And second, severe long-term restrictions are there, which impair its ability to remit funds. Again, you can understand the logic. If you include anybody as a subsidiary, and if it is going to go out very soon, it will be misrepresenting by including that in the group. And secondly, if that subsidiary has restrictions, suppose I have got a subsidiary in Zimbabwe, and government of Zimbabwe has declared that you are not allowed to send funds outside Zimbabwe. I have got lots of investment. What's the use? I'm not going to get any remittance from there. So it's my investment gone actually. Or maybe for some time I'm not going to get. So why to include and create true and unfair view? It's an unfair view. That's why not included. Right? So in consolidated financial statement, don't include. But don't include means what? Balance sheet has to tally. You have to somewhere include. In consolidation process, you don't include. But as per AS 13, accounting for investment, just simple investment करके keep it. Now, in scope companies, those companies which are under the scope of companies accounting standard rules, you're required to follow the standard, and standard says you can exclude. So as per Companies Act also you can exclude. However, you'll have to provide the reasons and explanation that these subsidiaries are excluded. Now I'll continue that issue. There are two things. That is, near future means what? Temporary near future means what? Right? That we'll have to understand. And there is one more thing when exclusion is not allowed. Following things should be borne in mind. Near future means generally not more than 12 months. If within 12 months it is expected that a subsidiary will be disposed of. Remember, if you are an auditor and if your client is excluding, unless you are justified, you'll have to qualify the report. In near future, should be possible to demonstrate that within 1 year it's being disposed of. The intention is important. Board resolution you can see, management letter not blindly relying, but you can see what is the intention behind investment and when they are going to exit. They already passed the resolution within 7 months we are going to exit. Then why to include it? Okay. And second thing, exclusion on the pretext that business is different. That's not allowed. You can't say that company's business, subsidiary's business is different. So what's the sense in including? You have made investment. You're supposed to include. Business will not decide that whether it should be included or not. Theoretical possibility. There is a banking company, theoretical, and it is holding control over insurance company. Format will be different. Change the format and include. But you can't say this is entirely different business. How can we consolidate? You have decided not to, not allowed. These two limitations you should remember. Now critical issues में हम आगे जाते हैं. Issue 2. Whether a special purpose vehicle or special purpose entity should be included. Special purpose entity created for a particular venture, particular objective, particular set criteria. The basic principle is that if economic benefits you are aiming or taking, then you should include special purpose to special purpose. Control is there. Objective of economic benefit is there. Then you must include that. You're not allowed. So you will find the basis of consolidating an entity is control and not whether it is a special purpose vehicle or something. So if control is there, you are not allowed to do exclusion. You will have to include control in substance. Could be circumstances like activities of the SPV are conducted on our behalf. You know, many times these road construction companies, they get the contract and 3 different portions of the road, 3 different companies they prepare and incorporate and give the work to them. So basically those 3 are extended arms of this. I have got a road construction contract. 10 kilometers I give to one company, 25 kilometers to another, 30 kilometers to another. So they are special purpose entities created. I cannot exclude them. Basically, this is for the purpose of extending my business, or I have power to control their decision making because I have got the majority voting shares. and retains a majority risk. If all these risk reward factors are there, I cannot. But I have got 15,000 employees. I've got my business to look after. For 15,000 employees, I need to do a lot of things like provident fund, gratuity and all. I don't want to do that. So I created one company, Employees Retirement Benefit Company Limited. Now what? That I should not, there is no need of including that because I hold the shares. This is only for the purpose of looking after that hassles. I have outsourced the work of looking after the staff. That economic benefits objective is not. The objective of control over such entity is not to obtain economic benefit. So you can exclude that. That is permissible. Now, issue number 3. A Limited holds, if you just want to see, I should not be too quick. You can just have a look at it. Anyway, I'll send the PPTs to you. Okay. Now, if A Limited holds 51% of the equity of X, B Limited, because of some shareholders agreement and all, controls the board of directors. Now what? Both of them are controlling. One is by shareholding, one is by board. What to do in consolidated financial statement? Well, both. It will be included in both. It will be included as subsidiary of whom? I've given the response there. That as per the definition of control, there are independent tests. I have said or in between, right? I showed you that we are going to cover it later. I told you. There are 2 tests and both are independent. So they will be included in both. It will be included in the composition because of composition of board of directors control and because of shares control. By both ways, it will be included in the financial statements of both. That's what I'll do. A few more issues and then I'll take up your questions. Okay, just see that. In both the groups, X Limited will be included as a subsidiary. Okay. Now one more. Is it mandatory to amortize goodwill or capital reserve, goodwill on consolidation? When you prepare consolidated statement, goodwill is a very common thing. See, goodwill is an intangible asset. AS26, you must have studied in this course. AS26 deals with intangible assets. But AS26 scopes out in the beginning only goodwill on consolidation. It says go to AS21 and deal with that. So AS26 amortization you need not see. Then what? You have to look at AS21. 21 is silent. It doesn't say, it doesn't prohibit, it doesn't provide for amortization. It doesn't say, simply quiet. Now what? AS26 says go to AS21. AS21 doesn't say anything. Then what? You may not write off, whatever way you want. But what will be the better course of action? The better thing is to test it for impairment. Impairment standard you have studied. So you check whether there is an indication of impairment and test it for impairment. That will be the best course of action. Okay. Now, can goodwill and capital reserve be eliminated, adjusted? Suppose there are 3 subsidiaries where there is a goodwill in consolidation process. There are 2 subsidiaries where there is a capital reserve. Shall I net it off? Again, AS21 is silent about it, absolutely silent. It doesn't say you do it or don't do it. Now, when there is no specific requirement, you may, and mostly everybody does that, set up goodwill and capital reserve. Now, if you want, in the notes to the financial statement, you may show the breakup. Goodwill arising on various consolidations is this, capital reserve is this, and we have net it off. It will be better. Giving more information is not a problem. You can do that. Okay. A few more issues and then I'll hand over to you. You have to ask me the queries. Whether all the notes appearing in the separate financial statements of parents and subsidiaries should be given. Well, to a certain extent, we already answered that. Each and every note, sundry, you need not include. Okay, I have told you already, basic principle. Once I tell you, you will understand the rest of the bullet points. Benefit from giving the information should be more than the cost. If I just keep testing all the information, chipka diya, if it's not going to really help, it's just increasing the number of pages, right? So benefit should exceed the cost. Now you can see what would be the next few bullet points based on this principle. It is obviously not necessary to include everything. Obviously not. Only those which are really they matter in presenting true and fair view, or they will affect true and fair view, they should be given. And those which are not material, there is no need of disclosure. Only thing is that additional statutory information, mostly subsidiary ke liye jo statutory information in statutory separate standalone statement you have given it. In consolidation, what's the use for the group? 3 different companies may have 3 different types of statutory information. Mostly that will not be required, but you have to take a call. Management has to take a call. Now we are coming towards the end, last one or two, and then you can ask. A Limited is an Indian company preparing statements under Indian GAAP, IGAAP. It has a foreign subsidiary, say in Bangladesh, Pakistan, Myanmar, whatever. How should A Limited prepare consolidated statement? You know the principle? It should be in the same form. I had hammered that earlier. It should be prepared in the same form and manner. So what you need to do? Subsidiaries financial statement, convert them to the form in which holding company prepares its separate statements. Make it compatible and then combine. Same format as that adopted section 129 as well as AS. Both are saying the same thing. So the only thing that you can do is first convert the financial statements of subsidiary in a suitable form like that of holding company and then consolidate. This is about 7th issue. So here I come to the end of this part. Now, if you have got any queries, questions, you can ask me. I'll answer to the best of my ability. Can I get the questions from the participants? Any questions? Hello? Am I audible? Hello?
Yes, sir, you're audible.
Any questions are there?
Sir, no, not yet.
Okay, then I will go over to the remaining slides, remaining standards. Perhaps at the end you can ask the questions, whatever
Yes,
you want.
sir.
Okay,
Yes.
thank you. Now we go for accounting for investment in associates in consolidated financial statements. I'll invite your attention to the heading itself. Accounting for investment in associates in consolidated statements. This doesn't mean that if you have an associate only, you have to prepare consolidated statements. What it means is that if you are preparing consolidated statements and if you have an associate, then how to present that associate? That's it. That is what it means. So if you don't have a group, if you don't have a subsidiary at all, you're not preparing consolidated statements, this standard would not apply. Just like in the previous standard, we'll go over to the definitions first. Now, what is an associate? Interesting. First of all, as per Companies Act, it says associate company means a company in which that other company, will call it as investor. Investor has a significant influence, but which is not a subsidiary of that other company, and includes joint venture also. Okay, so basically, in order that X Limited says that Y Limited is our subsidiary, what is necessary? That X Limited should have significant influence on Y Limited. What is significant influence? We're going to see that. For this purpose, control of at least 20% of total share capital. Same concept again. Total share capital or of business decisions is required. So if you have 20% decision making power, 20% equity at least, then you can say it's an associate. You will see that this 20% has got something to understand. Don't get misled here. 20% is not a sacrosanct rule, at least as far as the standard is concerned. Watch this. Accounting standard 23 says an associate is an enterprise in which investor has significant influence, same, and which is neither a subsidiary. So more or less same. It boils down to what is significant influence. And significant influence in this standard is said to be power to participate in the financial plus or only and or operating policy decisions, but not control. Okay, it is power to just participate. See, participating is different and controlling is different. I participate means there are others also. My view is considered, but I am not able to go beyond a particular level. But control means I can stop others from going ahead and put my foot down and get the things that I want to get done. Right? So power to participate. Now, where is this 20%? In accounting standard, where is this 20%? Which is there in the definition itself in the section. Well, if you go to the next slide, you will find that the standard says something, but look how it says compared to the Companies Act. For the purpose of this standard, significant influence does not extend to power to govern. Please remember, power to govern, power to participate are different. Govern means control. You can stop others, you can prevent others from having their say. And it can be gained by share ownership, statute, agreement, whatever way. Still, that influence and shareholding have not been joined in this standard. Standard does not start saying that with 20% equity, you have this so-called power to participate, having significant influence. They don't say. But as an explanation below the definition, the standard says, as regards share ownership, look how indirectly they say. Directly or indirectly, it holds 20% or more of the voting power. Now read ahead. It is presumed. They don't say you have a significant influence. It is presumed that investor has a significant influence, unless it can be demonstrated otherwise. Now, this is not the same as under the Companies Act. I'll take you back. See what Companies Act says. Control of at least 20%. For this purpose, significant influence means they're pretty sure. If you hold 20% or more, you have significant influence. Correct? It means. And what does this say? Accounting standard says it is presumed. If you have 20% or more, it is presumed that you have, though you can prove that it is not the case. That means in spite of having 20% or more under the accounting standard, you can still say I'm having 25% shares of another company. It can still be proved I don't have significant influence. How? We're going to see that in the critical issues slide. Now, converse, is it true? Opposite, I'm having less than 20%. Watch. Conversely, if shareholding is less than 20%, it is presumed, again, presumed that investor does not have significant influence, unless it can be demonstrated. Can we say that under the accounting standard, 20% is suggestive, just suggestive? It says, look, 20% or more, probably you have influence, or you can prove otherwise. Look, less than 20% you have, you don't have. You can prove that you still have. Remember, in Tata Group, Mr. Mistry had something like 17% or thereabout shareholding. And how big the legal battle was there? With 17%, why this much of battle? That was a significant influence. Having in one company 17% is not small, okay? So 20% is suggestive. With 20% or more, you still may not have significant influence, but it is presumed generally you have it. With less than 20%, you generally don't have, but you can still prove. Depends upon who the other holders are, isn't it? If I hold 20%, who 80% is the holder of? That will perhaps decide my 20% has got what value. What are my opponents? How much dominance they have, right? So 20% is suggestive, but Companies Act, no. Companies Act says nothing, 20% or more, it means significant influence. Now that is a major difference. Anyway, a substantial or majority ownership by another investor does not preclude necessarily. If I hold, say 20% and somebody holds 30%, that necessarily does not mean that I don't have, that person has significant influence. It's possible that both of us are having. It is possible that I am having, and in spite of 30%, he is not having significant influence. It all is based on the facts and circumstances. These are suggestive kind of measures. Considering the significant influence, potential equity shares are not to be taken into account. Potential equity shares, I cannot say I might have significant influence. I might have significant influence. No. Associate is what? When an investor has a significant influence. Has means in present, not in future. Has significant influence means at the time of reporting date, I should have. So future potential equity shares, you should not take. Now let's apply general principles of equity method. Now equity method is a method by which investments are recorded. Now let's go back to our original example, father and son. If father has 90% shares of son's business, so what father will say? All the assets and liabilities of son, I will add to my balance sheet, full balance sheet of family, and say 10% of some son's balance sheet doesn't belong to minority. I'll add all and say 10% doesn't belong to me. So what do you do in equity method? If he has 30% shares of son's balance sheet, he'll say, I'll add all assets and say 70% doesn't belong to me. Tomorrow, I will add in my balance sheet all the assets of Reliance and say 99.99% doesn't belong to me because I hold only 0.01%. That's ridiculous, isn't it? Therefore, if you don't have control, don't add all. If I have 30%, do you mean to say if I have 30% shares of that company, so it's my associate, so I should add 30% of each asset, 30% of each liability, like holding company? No, I should not. Then how to apply? Well, I will record my investment in such a manner, record the balance of investment, carrying amount of investment in such a manner that it will be equal to 30% of the net assets. So father will say, my son's all the assets, net assets are worth 1 crore. My share is 30%. So investment will be recorded at 30 lakhs. So investment balance itself will represent the value of all the assets. Don't add assets. Just say to it that investment is equal to value of your share. Right? How to do that? That is equity method. Equity method is such that you account in such a manner. Now look at what is stated. Watch this. Equity method is investment is initially recorded at cost. Father, when he makes investment, initially whatever he pays, and subsequently whatever share of profit he gets from the son's balance sheet, he will keep adding. So investment account is every time debited by his own share, every time debited by his own share, and it will go on. But otherwise, consolidation principles are the same. Calculation of goodwill, capital reserve is the same. The way you do it in case of holding and subsidiary, same to same thing. Only thing is that all assets, all liabilities of the subsidiary are added, and you say 10% doesn't belong to me. That's not done. Here, all assets and liabilities are not added. Your investment is reflected in such a manner that it covers 30% of your share. Right? Now, consolidated statement of P&L will obviously reflect. Suppose I wrote the whole P&L account of the group. And then I'll add 2-3 subsidiaries, my share, that will be added. So this is how the income and the assets will be reflected. And the distributions received by way of dividend are deducted. I keep saying my investment, add my share, less dividend received. Add my share, less received. So continuously, the investment will be carried over at a balance which will be equal to the percentage, my percentage of holding of that assets. This is how equity method is applied. We are not doing actual computational process out here. Otherwise, I would have been able to show that, right? So this is the way equity method is adopted. And changes from revaluation of assets, everything is done like consolidation in equity method, all of them are done, but the presentation differs. Now, what is the rationale behind using equity method? If I invest 30% in one company and cost is 1 crore, so why don't I say 1 crore and forget just 1 crore long-term investment, 1 crore. Why do I keep adding my share? See, holding 30% share, having significant influence means I'm able to participate in the decision-making process, right? So if that company fails or succeeds, in failure or success, I have got some responsibility, isn't it? So my responsibility, don't you think it should be included or reflected in the investment? I just can't say whatever I have paid is the cost, forget it. It's not like it. It's not like plant and machinery, land and building. It's not like that. It's my investment in the decision making of that particular entity. Therefore, this equity method is used. This is the rationale. The recognition of income on the basis of dividend received doesn't really reflect anything. If I just write my cost of investment and whatever dividend I receive, this will not give justice. So what do? I have got a significant influence. So as a measure of responsibility, whatever is my share of profit or loss, I will write and keep reflecting my investment, which will be equal to the net assets of that entity multiplied by my share. That should be reflected because the influence is quite strong. Investor accounts for this stewardship, control responsibility relationship in the financial statement by saying that that company's assets belong to me to this extent, so value of my investment is so and so. In short, you keep revaluing or marking up or marking down your investment to reflect that company's net assets multiplied by your share. And this is the logic behind it. That is the reason why equity method is adopted. Most of the procedures are same. Most of the procedures are same as you do for consolidation. So for application of equity, analysis of profit, the date on which you acquired, capital profit, revenue profit, the procedures, everything is same. What I said, only thing, don't add all the assets and say 30% or 10% don't belong to us. Your investment will be reflected equal to your share of net assets. Now the last point, as I said, in holding company, goodwill is there. Similarly here also, goodwill or capital reserve will be there. Suppose my investment last year, the investment in associate was 1 lakh. This year, investment in associate is 1,30,000. That means I must have added my share of profit. Now, when I acquired the investment, the initial goodwill or capital reserve which resulted, that they are saying should be included in the investment goodwill, but should be shown separately. You know what should be done? Investment in associate. Instead of saying say 1 crore, you should break it up. Goodwill 30,000, others 9,70,000. This is how you have to show. So goodwill part and net asset part should be shown separately. So whatever is the net asset part, it will be equal to the net assets of that entity multiplied by your share. If your share is 30%, net assets of associate into 30% will be reflected plus goodwill. That will be the value of investment under equity method. Unrealized profits are eliminated, but don't forget, to the extent of investor share, not like holding company. In holding and subsidiary, whatever transactions are there, you eliminate the profit entirely. What do you do here? To the extent of investors share. If I have sold the goods to associates and there is a profit of 10,000. So to the extent of 30%, my share, only that profit should be eliminated, not the entire profit. And unrealized losses, same thing. Unrealized profit or unrealized losses eliminated to the extent of investor's share. That is the biggest difference between consolidation under AS 21 and 23. Now, impairment of investment in associate. The carrying amount of investment in associate should be reduced to recognize the decline other than temporary. All of you must be knowing AS 13, long-term investment. Generally, they are at cost, except when a decline which is other than temporary, you have to provide for the same. Exactly same thing. Basically, because investment in associate is a long-term investment. Usually, nobody makes 30-35% investment in one company's share just for temporary purpose. So they are basically governed by the principles of long-term investment valuation. And that reduction separately for each associate you should make. Don't mix up, because each associate facts, circumstances are different. So for every associate separately, this is to be done. As far as disclosures are concerned, because the procedures are same, we have not taken much time. We're going to see some critical issues. As far as disclosures are concerned, in addition to those disclosures that why an associate is excluded and all, which are the same as in the case of holding company, the other disclosures are, you have to first of all include that under long-term investment. As I told you 1 minute ago, these investments are not held temporarily or as trading in nature. When you have significant influence, you don't want to dispose it of every year, right? It should be shown as long-term investment, and in the profit and loss account, the share in the consolidated profit and loss, the share from each and every associate accumulated should be shown. And then investor's share of extraordinary prior period item. Basically, whatever you do for separate financial statement, same thing you do. Anything to be considered from associate has to be mentioned. And in addition to that, the other details, name, country of incorporation, the type of business. You see balance sheet of any company, you will find list of names of subsidiaries. Many companies have more than 25-30 holding associates and all. So all those details, whether shareholders use that, do they really use it? What is the value addition? Don't ask me that. But then information is required. And in case associate use accounting policies which are different, as we saw in case of subsidiary, then you have to mention that these are the associates using different policies and we have not been able to do anything about it. You have to mention that. Now, little bit of critical issues. The first issue, while determining whether there is a significant influence, whether potential voting rights will be taken into account. I answered it sometime earlier indirectly, because significant influence means associate means a company over which you have significant influence in a present situation. Associate is an enterprise when investor has means having at present at the time of preparing balance sheet, right? Therefore, having significant influence at the time of financial reporting is required. Having some convertible debentures, if they will be converted, I will get so many shares, then I will definitely, you will have. You don't have significant influence as of now. So future potential voting rights cannot be considered for significant influence. Then A Limited holds 25% of the equity shares of B Limited. The balance 75% held by X Limited Group, and it has 100% subsidiaries who have substantial business interest in the operations of B Limited. Can it be said that B Limited is an associate of A? See, A Limited holds 25%. So if you go by that suggestive number, 20% or more, company X is, yes, you are associate. That B Limited is associate. Accounting standard says 20% or more equity, it is presumed, unless it can be proved otherwise, that you have significant influence. Now, do you have? Look at who the other holders are. I'm holding 25%. balance 75% is held by a group of X Limited and its other subsidiaries. So they are so dominant, they will negate everything. My 25% will become a mockery. Every time a resolution is to be passed, they will block it. Therefore, it is presumed that I don't have it unless I am able to prove that I do have, because they've got a power every time to block the resolution. An associate company which investor has significant influence, which is neither a subsidiary. This section says that power to participate comes from what? This is the preliminary part. Now comes the major part. In addition to this, who the associate is, that 20% part is suggestive. It says it is presumed that he has significant influence. So if you can prove that it is not so, or conversely, if I have less, I do not have significant influence, that has to be taken into account. Just because I have 25%, Companies Act says you are, but accounting standard says no. So we can say, even though A Limited has 25%, that 75% is held by a major group, and it has the power to block every time, and therefore it doesn't look like. Now you will say, under the Companies Act, it is an associate, what to do? It's a controversial issue. Companies Act clearly says more than 25 you are associate, but accounting standard doesn't. Now if you consider that it is not a subsidiary, will it be considered that you are not preparing financial statements properly? Well, there is a possibility. I would say accounting standards are also mandatory. As per standard, it is clear that you are not having significant influence. So you need not. You can give the reasons. You can give the other information under Schedule 3. You give the other reasons and say that it is not a associate, so we have not included. But it is better that there should be no difference between language of accounting standard and the law. Government should do something about it. Okay, here it doesn't look like that it is a associate. Now, before we start with AS 27, have you got any other queries? Anybody has anything to ask? Otherwise, we'll have a little break, just a break of 5 minutes. 2 standards are over and 2 more are remaining. We'll have a break of 5 minutes. No, there are no doubts. Can we have a break for 5 minutes now? Okay. We'll have a break for 5 minutes. We'll assemble after 5 minutes.
बस sir. Hello. Subhash sir,
Yes,
sir, sound sir.
I had given just a 5 minutes break.
Sir, mic चालू થશે वाला કઈ problem.
Is the mic on now? Can you hear me? Am I
Yes, sir.
audible?
Yes, sir.
I asked for the doubts and all, but apparently nobody had. I've completed the 2 standards, now 2 are remaining. Okay, let's begin. Now we'll go to the next standard, AS27, financial reporting of interests in joint ventures. Of course, in consolidated financial statements, when we are preparing consolidated statements of the group, in addition to holding and subsidiary company, if there are joint ventures, how the investment is included. When we use AS21, there is a complete consolidation. Complete consolidation in the sense that all assets and liabilities are added, and we say that so and so do not belong to us, minority interest. When there is associate, we don't say 30% of each asset or something. We just say our investment, the carrying amount, our investment in associate carrying amount is equal to our share in the net assets of the subsidiary. So investment gets reflected that way. Their assets get reflected in an indirect manner through the investment figure. And in joint venture, there is proportionate consolidation. If I have 30% investment in associate and 30% investment in joint venture, both will be reflected differently. If X Limited is my associate and Y Limited is my joint venture, in both the entities, I'm holding 30%. But associate will be reflected in my consolidated statement differently. Joint venture will be reflected in my consolidated statements differently. Associate will be reflected by way of investment being shown, which is equal to net assets of associate into 30%. That will be the carrying amount. And as far as joint ventures are concerned, each asset 30%, each asset 30%. That way it will be reflected. And subsidiary, suppose I hold 70%, each asset will not be multiplied by 70%. Complete consolidation. So in one consolidated balance sheet, if I have subsidiaries, associates, and joint venture, I have got investments in all the 3 companies. How they will be reflected will be different. Now this partial consolidation, proportionate consolidation, is on the way out. It is there in accounting standard 27. But as we move on to IFRS, in IFRS, even joint ventures are under equity method, not this. So as long as A's are on, this method will be there. When we exit, nobody is covered by A's. Some situation in some years later, this method will be out. It's no more going to be there. Now the definitions, as we have done in the other standards. What is a joint venture? Contractual arrangement under which 2, 3, 4, any number of parties undertake an economic activity which is subject to joint control. Economic activity which is subject to joint control, right? So 3 things are important. There should be contractual arrangement, preferably in writing. Though if it is oral, you can't say this is not recognized. They have not said it should be. But in every major business decision agreements, you expect it to be in writing. Okay, so contractual arrangement should be there. There should be an economic activity. Now, having provident fund or gratuity fund for employees is not economic activity, right? It is just a subsidiary incidental part. So it should be economic activity, aim of producing revenue, and it is subject to joint control. That means control is there, but not unilateral control. Remember, it should be joint control. Joint control means what? two entities. When do you say they have joint control? When without the acquiescence or without the consent of both of them, a decision cannot be taken. Then you say it's joint control. If unilaterally one company can take, it's not. Now, what is joint control? As I said just now, see whether it appears. Contractually agreed sharing of control over economic activity. So there has to be economic activity. Contractually, preferably writing, contractually agreed sharing of control should be there. Then only it is called joint control. Unilateral control, then it goes in subsidiary. So the control is of two types. Unilateral control, holding subsidiary. Joint control, investment. Joint venture. Now, what is a venturer? Obviously, the person who is a party to the joint control, isn't it? A party to the joint venture who has joint control. Now, what about a party to the joint venture who doesn't have joint control? Party to the joint venture but doesn't have joint control. Can there be a party to the joint venture who doesn't have control? Yes. A simple investor, he says, I am not going to be in the decision making process. I'll put my capital, sleeping partner. I'll put my capital. Or an operator of the joint control that is not even party to the joint venture. If you are given outsourced work to somebody that you do this work and will pay you for that, and that is not even a party to the joint venture. So basically, the one who participates in the process of economic activity can be said to have a joint control. And what is an investor? Holding subsidiary, investor, associate. These are the joint names. Similarly here, investor and joint venture. So investor is a person who is a party to the joint control. Investor is a party to the joint venture and does not have joint control. There are two types of parties. Parties to the joint venture having control and parties to the joint venture not having joint control. Two types of persons. Basically, when I said proportionate consolidation, it applies only when there is a separate entity and in which you have some shareholding, you have some joint control. Then only this proportionate consolidation applies. So what are the forms of joint venture? There are three forms of joint venture. Jointly controlled operation, jointly controlled assets, and jointly controlled entity. Watch this. Three broad types of joint ventures. Jointly controlled operations, jointly controlled assets, and jointly controlled entities. Mind you, when only operations are jointly conducted or only some assets are commonly shared, like oil pipeline shared by 2-3, or railway siding, railway line shared by 2-3 industrial companies, that is strictly speaking not that is out of consolidation. Jointly controlled entities, suppose there is A Limited, B Limited, they have promoted, they have formed a company C Limited in which they hold 50% shares. Now that is jointly controlled entity, and basically JCE, jointly controlled entity, we are going to consider for the purpose of that proportionate consolidation. Now I have not taken separately intricate issues, they are included here itself. Interaction between AS 21, 23 and 27. You know what is holding subsidiary, you know what is investor and associate, 20% at least shareholding unless it can be whatever, and joint control. Suppose X Limited has a joint venture agreement with Y Limited. They have incorporated Z and X holds 60%, Y holds 40%. X holds 60%, Y holds 40%. This kind of 60-40 joint venture is there. X Limited is preparing its consolidated statements anyway. So will it treat that Z Limited as a joint venture, or will it treat as subsidiary because it is holding 60%? This is our issue. A Limited has a jointly controlled entity B, and A Limited controls more than 25% of the voting power of B Limited. A Limited is preparing consolidated financial statement. How it will be taken? So if you have a joint venture where you hold Significant influence. If you have a joint venture where you hold more than 50%, so will you treat that as an associate? Will you treat that as a subsidiary? In short, which standard overrides which one? If there is associate, if there is joint venture, which is subsidiary also, and if there is joint venture, which is simply associate, which standard will override? Well, 21 always overrides. Holding subsidiary always overrides. But 23 does not override. This is what you have to remember. If A Limited holds, this is mistake, no? Not 25, it should be 75. There is a mistake out here. A Limited controls 75%. I will cancel this and make a new one and then send it to you. So if A Limited is a holding company, then the fact that it is holding company is more important than the fact that the other company is a joint venture. So between AS 21 and 27, which overrides? 21. But see the second issue. If A Limited simply holds 35% in the joint venture, so that way it has significant influence, but it is a joint venture also. Then the fact that, how will you consolidate? The fact that it is a joint venture will have priority over associate. So if there is an entity in which you hold shares and it is a associate, it is a joint venture, consider, do you hold more than 50%? Then even if it is joint venture, you look at AS 21, treat it as subsidiary. If you hold not control, but simply significant influence, but if it is your joint venture, then don't consider it as AS 23, it will be AS 27. Now, accounting. As far as jointly controlled operations are concerned, suppose X Limited is construction company, Y Limited is information technology company, and they have come together to build a theater. A Limited will look after the construction part, B Limited will look at the technological part, and there is no other company, etc. They just happen to come together, they just work together. There is no consolidation in that case. Then what will you write in jointly controlled operation? Your share of assets, your share of income, your share of expenses. That's it. Don't prepare a consolidated balance sheet in which include your investment. The assets that it controls from the joint venture, the liabilities that it incurs on behalf of joint venture, and the expenses that it incurs for the joint venture, and the income that it earns from the joint venture. This is what is done. Same thing about jointly controlled assets. Suppose there is a pipeline, a big pipeline, very costly one, and there are 5 industries which have outlets from that pipeline, and they share the pipeline, repairs and maintenance together, ownership together, ensuring that together. Then what? Same thing, no consolidation in that case. Even in respect of that, in your statements, what will you write? The share of jointly controlled assets in your PPE, wholly owned PPE, jointly owned PPE. In your inventories, wholly owned inventory, jointly owned inventory, and so on. Similarly, any liabilities that have been incurred and share of liabilities incurred jointly. In short, principles of consolidation don't apply. What did I say about three types of joint ventures? It is only in jointly controlled entity, the third part, where the consolidation comes into picture. All these are only to the extent of your share. There is nothing great that you can learn from here because you are just partly the owner of some kind of resources. So record only that much. This is what is required to be accounted and disclosed for the first two. So consolidation related standards we are learning. The consolidation comes only in case of third venture. I have taken it separately. Accounting in case of jointly controlled entity. A jointly controlled entity is the one which involves establishing either in corporate form, LLP form, or any other form, a separate organization, and not just having two companies sharing resources. Separate organization is there. And if separate organization is either by shares or by voting rights or by decision making, they are jointly controlled, then it is called JCE, jointly controlled. It operates just like any other enterprise. Only thing is that there are 2 or 3 persons who are running that organization together, right? So the question of consolidation comes in. A jointly controlled entity maintains its own records because, as I said, who controls different. It's a separate corporate existence, legal existence it has. It has its own or corporate office. It has got its own assets, own employees. Only thing is that the ownership is controlled by more than 2 and jointly controlled, right? So if it has a separate existence, then in consolidated statements of all those persons, how it will fit? As I said, proportionate consolidation method. Remember, this method world over is already outdated. In India, we have AS. So we are following this. Outside India, what we are calling today IFRS, they have debarred this particular method, proportionate consolidation. Each asset to the extent of your share, each liability to the extent of your share. No more. Only in India, in AS that also, IGAPs, it is there. In consolidated statements, we should report by proportionate consolidation share of your assets. Whatever investment you have made, that investment will be broken. Each asset to the extent of your share will appear. So literally you will have to search throughout your balance sheet that where are all the assets scattered. It obscures your share or your stake, and that's the reason this has been eliminated worldwide. We still have it under our old days, and therefore what will be the disclosures under this standard? Similar to AS23. If venturer is not included, what to do, how many venturers are there, what are their names, country of incorporation, general information, the share of contingent liabilities that you incur on their behalf. This is something, I mean, by reading also you can understand, very basic kind of things. Disclose the aggregate amount of commitments, Are you able to see this?
Sir.
Yes, sir. Yes, sir.
Sorry for the interruption. I've started from my mobile. Okay. So these were the disclosures. Now we were about to start with accounting for amalgamations, the last of the standards. As you might have heard, you might be aware that this particular standard, accounting for amalgamation, this has been substantially revamped. This has been substantially revamped. And in the new standard, Ind AS 103 and Ind AS 110, there are substantially changed requirements. Basically, AS 14 falls short of the requirements of true disclosures and accounting. Nevertheless, that is the standard we are having. So what is scoped out from this standard? The screen is visible, I guess.
Yes, sir.
Hello? Yeah.
Yes, sir. Visible.
Oh, thank you. So what is scoped out of this standard? Basically, this standard talks about only amalgamations where entirely the assets, liabilities, and the entities acquired. Share acquisition is not included. This standard has scoped out cases of acquisitions. Acquisition means A Limited takes over the control over B Limited by share acquisition. It is not necessary that company should be closed down. Everything should be taken over, right? These acquisitions under the modern standards, the new standards, there is financial instrument standard which takes care of all this. But unfortunately, the old accounting standard 14 talks about complete liquidation of the old company and taking over of all the assets. Acquisition arises from purchase of shares, not assets, right? Purchase of the whole or part of the shares, basically. In that case, this standard absolutely is inapplicable. So what is the distinguishing feature of this standard? That the old company, the one which is being taken over through shareholding, ownership, it is not dissolved. It continues. Then this standard does not apply. So fundamentally, we apply this standard only when B Limited is completely closed, all these assets, liabilities, and everything is taken over. Some of the shareholders may join, some of the shareholders may not join this company, but basically the existence, legal existence of B comes to an end. There are two types of amalgamations, as you all must be aware. Amalgamation in the nature of merger and amalgamation in the nature of purchase. These are the two mergers, and for which two different methods are there. For amalgamation in the nature of merger, we apply pooling of interest method, and for amalgamation in the nature of purchase, simply purchase method is used. Now this amalgamation in the nature of merger, what you call pooling of interest, sounds to be a very odd kind of method. We're going to see that now. Mind you, under the new standard, IFRS, Ind AS 103, IFRS 3, it's not recognized. It's not recognized at all, pooling of interest method. But let me also tell you that our Ind AS 103 has got one carve in. I'm not teaching you Ind AS, but relevant point, I'm just making you aware. There is only one carve in. There are hardly any carve ins in Ind AS, or all are carve outs. And the only carve out is in Ind AS 103, there is Appendix C, which talks about common control business transactions, CCBC, common control business transactions. And in those common control business transactions, entities under the same group, when they get amalgamated, IFRS says nothing about it. IFRS 3 doesn't say anything, but Indian standard, Ind AS 103 says we will use the method which they have said is nothing but pooling of interest. So don't be under the impression that this is only in India, outside India it's gone. India has still maintained in Ind AS 103 also this pooling of interest. Only thing, when entities under the common control, when they join, then only this is used, otherwise not. But IASB is considering that method once again. They are bringing it back for common control business transactions. Deliberations are going on. India said we will not. India has still kept it. So this is the point to be noted all over, that India has still maintained this method. Now, what do you mean by amalgamation in the nature of merger? There are 5 conditions, all of which should be fulfilled, not 1, not 2, everything. Even if 1 is not fulfilled, it becomes amalgamation in the nature of purchase. So what are those conditions? Then only it will be amalgamation in the nature of merger. All the assets and liabilities of transferor company become, after amalgamation, assets and liabilities of transferee company. All assets. Nothing should be. Normally it's okay. All assets taken over. Suppose A Limited is taking over B Limited. Of B Limited, all the assets are taken. But there is one asset of B Limited which is pledged, hypothecated against a loan, and that was given away in discharge of loan, so it could not be taken. So will you say that condition not fulfilled, condition violated, it's not amalgamation in the nature of merger? Practically, whatever were possible, all were taken. That asset could not be taken. It couldn't be taken. Why? Simply because that was asset pledged. Now what to do? Strictly speaking, condition is violated. But then if you put conditions like this, it becomes so ridiculous at times. If one of the assets is not taken because of such reasons, then what can happen? There are some employees who retired, and for that, whatever the liabilities were there, they had to be discharged away out of the investments kept, and the remaining things taken over. Strictly speaking, condition not fulfilled. So basically, it becomes difficult to fulfill all these conditions because of some technical issues sometimes. That's the way it is. Shareholders holding not less than 90% of the face value of equity shares of the transferor company become equity shareholders. Those who hold at least 90% of the shares. Of course, there is an asterisk. 90% means other than those which are already held. Watch this. While counting 90%, those which are already held by transferee company, subsidiary, nominee, they don't count. Suppose I'm taking one company. Out of that company's shareholders, some shares I already hold. How can I take over? Some shares are held by my subsidiary. Some shares are held by my nominee. Remove those. See the rest of the shares. Who are holding? And 90% of that at least held by whom they should join. Other than me, my subsidiary and associate. Let me tell you, in income tax, you've got section 2 clause 1b, amalgamation. Section 2 clause 1b. There also something similar is there. Only thing, there is 90%. Instead of that, there is 3/4, 75%. But conditions are similar out there. The consideration is discharged only by issue of equity shares. Equity shares, not convertible preference shares, convertible debentures, bond, nothing, only equity shares. Of course, if I say for every 3 shares held, I'll give you 1 share, and they are not perfectly divisible, some fractional shares are there. If I give cash for fractions, that's okay. But otherwise, it should be strictly in equity shares. The business of the transferor company is intended to be carried on. If I take over and close that, I have taken it over only for tax benefit. This is not called merger. Amalgamation in the nature of merger means it's truly as if 2 entities are as if same, everything continues. Only thing is that instead of 2, they continue as a 1. All assets, all liabilities. In fact, the accounting assumes that you two are one and the same. Complete unification. That is why it is called merger. And no adjustment is intended to be made for the book value of assets. Of course, if different accounting policies are there, I follow FIFO and that company follows LIFO. So I'll have to make some change to bring it in line. That's okay. Except that no change should be made. If I fulfill all the 5 conditions, it is amalgamation in the nature of merger. Then I'll use pooling of interest method. If one condition is not fulfilled, This amalgamation in the nature of purchase. Purchase method will be used. So what is amalgamation in nature of purchase? Any one or more of the conditions is not fulfilled. Just a single condition not fulfilled. It is simple amalgamation in the nature of purchase. So what do you do in pooling of interest merger method? Mind you, again in IFRS, this method India has continued for common control business transactions, right? And world over it is being reintroduced. It is being reintroduced. They are considering first shall we include that once again. India has taken a stand that we will not exclude that. Pooling, to pool together, bring together, amass together. Pooling of interests. Interest means stakes. Pool the stakes. All assets, liabilities at book value. Everything is added together. Now, if I add everything, assets, liabilities, and everything, even the reserves are taken. Reserves are also taken, all types of reserves. In other words, assets minus liabilities and reserve is share capital. The share capital is compared with the consideration. Share capital is compared with the consideration, and the difference is adjusted in reserves. Sounds rather odd. Taking over reserves doesn't appeal our mind. That's the way it is. Assets, liabilities, reserves of the transferor are recorded at existing value. Even general reserve plus general reserve, statutory reserve plus statutory reserve, all reserves, all liabilities, everything is added. And the difference, the balance of profit and loss accounts are also merged. General reserves are also merged. Complete unification, complete dovetailing. And the difference is not treated as goodwill or capital reserve, what we normally do. The difference is adjusted in the reserves. You think that as if they were separate, they were never separate. They are just standing together. And therefore, everything gets added, and this is the result. The transferor and transferee companies have conflicting accounting policies. You may bring it in uniform set of accounting policies and adjust the effect just to make them together. But pooling of interest method was questioned by many. And that's how that is the position as of now. But purchase method is relatively simple. Everybody knows that. Simply all assets taken over, less liabilities taken over, at whatever values, you compare that with the purchase consideration. And if you paid more, it's goodwill. If you paid less, it's capital reserve. That is more rational, appealing to the mind. Assets and liabilities are included in whatever values. Alternative is there. You can include them at fair values. Include them at fair values. Or the consideration you may allocate over the assets. If I take over assets, I need not look at the old book values. I can say I have paid 1 crore. 1 crore may say how much per first, how much per second. Obviously, I will allocate that in the ratio of fair values. I will not look at what the value in the books of accounts of the old company is. I will say what is the fair value, and accordingly I'll allocate. And once I allocate that, if the difference arises, if I have paid more than the values at which I record them, the excess I have paid, but I have not got a tangible asset, that's goodwill. If I have paid less, capital reserve. And if there is a goodwill, you're supposed to amortize it, maximum over 5 years. That's what the standard says. Goodwill arising is to be allocated on systematic basis, not exceeding 5 years. Now, why 5? What is so systematic about 5? Well, this is what standard says. 5 itself is not systematic. Amortizing that goodwill by impairment method, that would be a better thing to do. Reserves are not taken over. Unlike in the earlier method, don't take reserves. Only assets and liabilities are taken over. That also not necessarily all. If there is a statutory reserve, that you take over. You know, under Income Tax Act, some reserve is created, and Income Tax Act says even if amalgamation is there, continue to fulfill the conditions, or else you lose the benefit. So take over that reserve. Amalgamation adjustment account debit to reserve. Take it over technically, keep it, and once the period remaining under the law is over, then write it off. That is purchase method. So this old standard really doesn't have much to offer. So rather I have taken critical issues Now, these issues are those which are addressed by expert advisory committee of our institute. 23 volumes have been purchased by now. So I've gone through and found out some appealing issues. I hope you find them interesting. What are the critical issues? The first issue, watch carefully. A listed service company finalized the scheme of merger of wholly owned 3 subsidiaries. Business of the subsidiary companies, as you know, that condition are intended to be carried on. You don't want to close them. Probably all assets, liabilities we are taking over. Probably everything else we are fulfilling. Parent company recorded all the assets, liabilities and everything at the fair value. Intercompany balances were cancelled as is required. The difference was transferred to capital reserve or maybe goodwill, whatever. The conditions relating to no change to be made in the books are not fulfilled. Because if you want to say that it is amalgamation in the nature of merger, one of the main conditions is that all assets, liabilities should be taken at book value. Now, how you should classify this amalgamation? Okay, that is what the issue before expert advisory committee. Now, committee, when it gives opinion, it doesn't give single line opinion. It first considers all the facts, circumstances, legal positions, analyzes, interprets. So committee analyzed and said that AS 14 doesn't give you a choice. Why did you do that? If you do it, if you violated the condition because of this reason, will allow, but otherwise you should nothing. It is very clear. Now, company did not meet the 5 conditions. Why it could not meet the conditions? One of the conditions, that reason is not important because there is no exception given. Like what we saw today, 2 layers, more than 2 layers not allowed, but 3rd layer is allowed if it is so. Aisa kuch nahi hai. Therefore, committee said that there is whatever the genuine reason because of which it was taken. There is nothing that can be done. Even if the law has stated that you have to take it over at this value, at that, you have not fulfilled the condition. It will be amalgamation in the nature of purchase. So it tells us one thing, that conditions are unbreakable. There is no exception available, howsoever genuine. If conditions are not fulfilled, no way it will be considered as amalgamation in the nature of purchase. Now, second critical issue, perhaps more important. There was an amalgamation in the nature of merger, and there were 3 companies. The company approached the expert advisory committee with what? What was the nature of reserves? Capital or general reserve? When 2 companies merge, there is a reserve. Will you call it as a distributable profit? And whether such reserve is available for declaration of dividend? See, when 2 companies come together, it's a transaction of capital nature, right? It is not a profit earned from the revenue producing business activities, ongoing activities. So the profit has to be of capital nature, right? Expert advisory committee said that in order to decide whether the reserve should be reflected as capital reserve or what, the D is not required. That they had given example ABCD, D is not required. So the nature of transaction has to be decided. And as you know, taking over a company is not a transaction of revenue nature, right? In that case, it has to be considered as a capital reserve. And once it is capital reserve, it cannot be considered because the resources of the company change. Transaction of capital nature. So the difference between whatever issued share capital of the transferee company and share capital, that should be treated as capital reserve. And once it is capital reserve, standard doesn't say it's capital reserve. It was interpreted it's a transaction of capital nature. It is then not available for distribution of dividend. Now the third issue, and that is regarding A Limited amalgamated with B Limited under the scheme of amalgamation, which was filed with the High Court, because unless High Court's permission is given, it is not possible to take it over. The scheme was filed with the Registrar of Companies. That second requirement was also fulfilled. The effective date. Now, date of amalgamation is what? Is there any particular date, 12:35 p.m. AM? This is the time at which amalgamation was completed. Can you say a calendar date? This is the day on which it is done. What is the effective date? Now, when the effective date of amalgamation, the day on which the consideration was paid and legal entity was transferred. See the dates. There are 3 dates I can see. First thing, you have filed with High Court on 1st January 21, 1st Jan 21. Appointed date in the scheme was much earlier, 1st December 20. Registrar of Companies 5th April 21. That goes beyond the balance sheet date. Correct? Year ending is 31st March 21 and registrar registered it on 5th April. In this scenario, will you include it in the current year, 31st March 21, or will you say it has occurred after the balance sheet date? That was the issue. It was held by the committee that effective date, the transaction, events occurring after the balance sheet date, the registrar registered it, it happened after the balance sheet date, but it gave some information about conditions which already existed at the balance sheet date because the process had already started. The amalgamation is effected from the day on which assets and liabilities vest in the transferring company, and the whole process, effective date for accounting, was before the balance sheet date. Registration gave effect or confirmed the fact of what was done. So expert advisory committee held that this is to be accounted for on 31st March 21 itself. Since the effective date of accounting would be prior to the balance sheet date, in the balance sheet on 31st March 21 would be in compliance with AS 14. So these are some of the issues which I wanted to discuss. From my side, the discussion is over much before time. If you have got any queries or any questions to be asked, doubts to be asked, you can. Otherwise, it's over from my side. Thank you very much. Any queries?
मिश्रा सर कोई
Hello.
क्वेरीज है? मिश्रा जी?
Okay, ma'am, 2 seconds.
Okay, so we don't have any questions. Any
Okay.
participants who would like to
No,
ask
ma'am, question नहीं एक भी.
questions?
Madam, question नहीं एक भी.
हाँ? नहीं है ना questions?
नहीं एक भी नहीं है.
Okay.
हाँ,
Okay.
so
Then
there is
my
no
question.
question. So I
Okay.
think, sir, I could say that much that your section was so exhaustive that we don't have any queries by the participants. Thank you very much, sir, for your valuable time and the way you have taken up the session practically with all the examples, illustrations, etc. that our participants have really good takeaways to take back home today, and they have really gained a lot of knowledge from you. Thank you very much, sir, for sharing your knowledge and expertise with our participants today. I, CA Ashita Shah, on behalf of WIRC, extend a hearty vote of thanks to you. Thank you very
Thank
much,
you.
sir.
Thank you.